In recent years, it's been hailed as an economic tiger, but Ireland today is a country deeply in debt and racked by a property crash, failed businesses and climbing unemployment. It's now also the latest front in the desperate battle by the European Union to calm market panic and keep eurozone countries from defaulting on their loans. Irish officials have now agreed in principle to take a bailout worth tens of billions of dollars. But the Irish public is bracing for a tough second round of austerity cuts, and analysts are still watching closely to see if this rescue will be enough to stem the crisis threatening other countries in Europe. To discuss the bailout and its implications for the global economy, a short time ago I spoke with London-based Westpac currency strategist Lauren Rosborough. Lauren Rosborough, what details have emerged about the size of this bailout and how it will work?
Well, the middle of last week, what we did know was that Ireland said that they didn't need a bailout and they didn't want one, but EU officials were very open in saying, well, the fund is here if you do. Now, over the weekend, EU and IMF officials have been in Dublin, and officially, Lenihan, the finance minister, has officially asked for a bailout from the European Financial Stability Fund.
What size bailout are we talking about?
No one really knows. Now, Ireland has stated for a long time now that they don't need one in terms of their fiscal balances on the government side. Unfortunately, in 2008, the Irish government had a bank guarantee, and it's the banking sector and the banking system in Ireland that's been struggling. That inextricably links the government with the banking sector. So what's happening now is that EU officials are looking into the bank balance sheets and into their books to see by how much is a reasonable amount to have a contingency fund that the Irish government can then overlay and pass through to the banks.
To what extent will this bailout ease the potential spread of financial instability to other European countries, stop the contagion?
Well, no one really knows the answer to that. Now, what we saw with the Greek crisis was that bond spreads blew out quite dramatically. The EU put in place the fund. Also, the IMF put forth a potential $250 billion towards helping peripheral economies. The market settled down. And what we've seen now is this has picked back up with Ireland. So the question does remain, will the markets now swivel its turn and look towards Portugal, look towards Spain, and wonder by how much can they grow themselves out and by how much can they cut their fiscal deficits into 2011 and 2012.
Now, it wasn't that many years ago that Ireland was referred to as the Celtic tiger. Its economy was strong, business was booming. What went wrong?
Oh, well, what went right, actually, I think might well be the problem. Ireland, in the doldrums, cut corporation tax to 12.5%. The economy started to pick up. There was large investment. Government finances did very well. Employment increased and housing market started to pick up. And then later on in the 1990s, they joined the EMU. What that meant was Ireland had the ability to then have very low mortgage rates. So interest rates fell. They had access to capital markets of Europe rather than Ireland. That spurned this housing boom, and unfortunately the banks were over-leveraged to the housing boom, such that when the boom effectively turned into a bust, the banking system was very weak.
What does this financial instability mean for the whole eurozone? Because there's been a suggestion that it could be the end of the European Union if it's not sorted out.
There's very much a political question about the eurozone and the EU overall, not just an economic and a monetary one. In terms of the market's perception for the eurozone, at the present it is somewhat weaker, but if you look at where euro-dollar is trading around that 136, 137, you wouldn't think so if you looked actually at the numbers. And that's because there's a lot going on around the rest of the world. For example, the US is undertaking quantitative easing, which has had the effect of weakening its currency. Germany and France Germany in particular, are still very strong economies and are holding up Europe overall. So to the extent of which where Eurozone as a whole is going, I would argue you need to look at the larger economies going forward, not just at the smaller or the weaker peripherals.
Is it fair to say that some of the stronger countries like Germany, although they obviously don't want the other countries to fail, are getting sick and tired of having to bail out other countries within the European Union?
It's more a question about paying for the excesses. Merkel has said this many times over, and that is if you had, many excesses in the 1990s and in the 2000s, then there will have to be some form of payback. That said, Germany is part of the eurozone and has always stated that it will help out if necessary. I mean, that is what it is. The eurozone as a whole, you help out your neighbours in times of need, and they are willing to do that. Naturally, if you do ask for a bailout or if you do ask for a loan from the fund, then you will have to have some form of fiscal restraint on your economy going forward. That's agreed between EU officials and the country in question.
The Irish people had already had austerity measures imposed. Now there will obviously be another round.
Unfortunately, what we have heard is that immigration is likely to be quite high, and indeed, in fact, the talk is that a lot of young Irish people are looking to move to places like Australia and the mining boom, who have relatively strong growth rates, New Zealand, Canada, the US as well. That can have negative impacts on the economy, or certainly does in terms of tax revenue, but it also takes pressure off things such as the unemployment benefit. So it's a two-way camp effectively for Ireland from here, and it's going to be very interesting to see how they manage their finances going forward and how the market perceives that going forward and allowing them to access capital markets in 2011.
So Greece had problems back in May, now Ireland's having problems. Is this the beginning of a domino effect with Portugal next in line?
I think one of the reasons why Ireland did agree to ask for a loan from the EFSF was because of the potential sentiment spillover and contagion impacts into Portugal and Spain. In September, Ireland said that they didn't need to access capital markets for its economy on the government side, the fiscal side. And they said that they didn't want to at the bond levels that they were in September. Now we're into November and the levels are so much higher. So to some extent, Ireland's helping itself, but not just that, also helping Spain and Ireland by calming the markets and saying, well, you know, let's pull back these bond spreads. Let's make it more palatable to be able to issue debt into the markets when they need to, and in Ireland's case, that's not until mid of next year.
So far, Australia has managed to remain relatively unscathed as these global crises take place. Do you think that's likely to continue?
Australia is a very different case, and there's two reasons for that. Is that Australia's growth is looking towards Asia and non-Japan Asia in particular, not just intra-growth in terms of Australia's economy. In addition to that, the market perceive, and certainly we can see it, there's very strong fiscal balances for Australia and for strong growth going forward, not just on a cyclical basis, but also a structural basis with the mining boom that we are seeing. Now, this is a 5 to 10 year story for Australia, and consequently it is in a much stronger position than, in fact, most other economies in the world at present, and is likely to be able to withhold any or withstand any shocks, if there are any, to the economy over the next 5 to 10 years.
Lauren Rosborough, thanks for speaking to us.
Thank you.